move to our next witness, who is Dr Andy Schmulow of the University of Wollongong. And I welcome you, Professor Schmulow. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. Can you please state your full name and capacity in which you appear?
Good morning, Chair, and good morning to your colleagues. It's a privilege for me to appear before you and them again. My name is Andrew Schmulow. I'm an Associate Professor in the Law School at the University of Wollongong, a Visiting Associate Professor in the Nelson Mandela Centre in the Oliver Schreiner School of Law at the University of the Witwatersrand, and a Visiting Fellow in the School of Law in the Ross Parsons Centre at the University of Sydney.
Thank you very much. Do you have an opening statement?
Yes, I do, Chair. The housing crisis that we face is a terrible mess, and in that regard, I think that the Reserve Bank of Australia has, for the last 20 years, fiddled while Rome has slowly smouldered, and APRA has poured fuel onto the fire. And I think that there are opportunities to rebalance the extent to which first-time home buyers can enter the market. And that can be rebalanced through a more proportional approach to regulation. And I should stress at this point, Chair, my field of expertise is financial regulation, and I limit myself to issues of financial regulation in the analysis that I put before your committee. That concludes my opening statement.
Thank you very much, Dr Schmulow. One of the things that I was interested in hearing from you about is in relation to the regulatory architecture, and in particular the way that APRA has been set up by Parliament. We might have lost Dr Schmulow there, have we?
I'm back.
Okay, we're back. So my question is, the previous witnesses made the point that Parliament had not asked APRA to think about first home buyers. What do you make of the approach by APRA over the last couple of decades? Have they just been doing effectively what Parliament has asked them to do?
No, they've effectively been doing what Parliament has not asked them to do. Here I want to take issue with some of the points made by Mr Reardon. He is correct in practice that APRA's role is limited to financial stability, but he is quite wrong in theory. APRA does have a competition mandate, and it is required under the legislation that creates APRA to balance its regulatory enforcement in order to ensure that we have competition in our market. Now, in 2018, the Treasury conducted a capability review of APRA, very ably led by the former ACCC Chair Graham Samuel. And in Professor Samuel's analysis of APRA, he points out at recommendations 2.2, 2.3, 3.7, Roman numeral 21, and page 3 of his report, that APRA should have a competition champion, that it should ensure that it fosters competition in our banking market, and APRA has ignored all of those instructions. Now, the reason why that's so important is because first-time home buyers will be more likely to be able to buy a home if they have a greater range of opportunities in order to raise a mortgage. And here again, Chair, I must disagree respectfully with what Mr Reardon said. He says that tax regimes won't to change tax regimes will not enhance supply. I think that's only one half of the equation. The full equation is that reducing tax advantages, I'm sure, will reduce supply, but rebalancing the opportunities that first home buyers have to enter the market will increase supply. And enabling first-time home buyers, when he says that that will not affect demand, that seems to me to be intuitively wrong. And while he may have economic modelling to support that, bear in mind that every economic model is based on assumptions. And often, in my experience as a legal academic, who collaborates extensively on research with economists, I find the assumptions that economists make and put into their models simply untenable.
Okay.
So I think that there are opportunities to enable first-time home buyers to enter the market without further supporting owner investors by broadening opportunities for first-time home buyers to raise a mortgage, and that requires more competition in the banking industry.
Okay, so effectively your evidence is that APRA already has a competition mandate, which it may not have fulfilled as well as it could have. And I guess my next question is then, well, if there was a requirement for APRA to take into account competition as well as in relation to first home owners or prospective first home buyers, then would that be sound from a regulatory perspective?
Would that be what, Chair?
Well, would that be sound and reasonable if that was part of their mandate?
Well, the Treasury Capability Review was of the view that they should. The Productivity Commission was of the view that they should. Professor Rod Sims stated, we have a cosy banking oligopoly, which is surely at the heart of recent problems, so we must and will find ways to get more effective competition in banking. And I think that one of the problems that prudential regulators have is they have difficulty in walking and chewing gum. They are laser focused on financial stability at the cost of everything else. But if you're going to pursue financial stability and in the process kill the productive capacity of the economy, well, what have you achieved?
Okay, so I just want to ask you this again. So if there was a situation where APRA's financial stability mandate was maintained, but they had another objective to foster home ownership, they would be able to achieve that in your opinion or not?
Yes, I think they can. I think that they could tweak their regulations so that there are more favourable conditions for granting mortgages to first-time home buyers, particularly those who are under a particular threshold salary. And I think what they could also do is enable smaller banks and credit unions to compete on an equal footing. I'm not talking about advantaging smaller banks and credit unions at the expense of the Big Four. I'm saying that currently, the Big Four enjoy advantages in their business models which enable them to raise funds, enable them to extend loans at prices that smaller banks and credit unions cannot match.
That is very helpful. Thank you very much, Dr Schmulow. I'm just seeing whether there are any further questions. There are. Yeah, Senator Barbara Pocock.
Thank you, Chair, and thanks, Professor Schmulow. Good to see you again. I'm just wondering, you're talking about your concerns about competition in the banking sector. You spoke about that at our consulting inquiry also. Are there ways to increase competition in the banking sector without loosening the responsible lending laws? And have you got concerns about the effect of loosening restrictions that protect vulnerable customers from ending up with crippling debt?
Yes. One of my research foci is on protecting vulnerable consumers from reckless and predatory lending. And Commissioner Hayne, in his findings at the Royal Commission, stated that responsible lending laws are correctly calibrated and they should be left alone. And when you remove restrictions on responsible lending laws, what you're really saying is let's lend irresponsibly. And let's reflate the economy by throwing vulnerable consumers under a bus. I don't think that's a solution. But the ways in which competition in the banking industry can be fostered without undermining responsible lending laws, I'll give you a few examples. Major banks enjoy advanced IRBM facilities. IRBM is internal ratings-based models. So the major banks are able on their own to determine the risk weightings of their own assets, and by determining on their own, of their own accord, the risk weightings of their assets, they then decide how much capital they have to set aside for each loan. So they can game that system, and they have been gaming that system all over the world, which is why IRBM models have now been tweaked so that there are floors and ceilings. The only reason why the Bank for International Settlements has recommended that floors and ceilings be put under IRBM models is because systemically significant financial institutions were gaming those models. Big banks have a self-assessment process. Small banks and credit unions don't. They have that assessment process imposed upon them. They pay more for the cost of finance, that is, small banks and credit unions, because they don't have an implicit taxpayer guarantee, the kind of implicit taxpayer guarantee which covers institutions which are regarded as too big to fail. So as a result, small institutions have to put up more capital for every mortgage they lend. They have to pay more when they borrow money in order to on-lend it for mortgages. And so all of this makes them less competitive. In addition to which, the major banks refuse to take deposits from small banks. There's no reason why they should refuse to take deposits from small banks, and that should be outlawed. The reason why they refuse to take deposits from small banks is to try and squeeze them out of the market. This is a form of anti-competitive behaviour that has passed under the radar. Moreover, as one CEO of a small bank said to me, he said, we're in a situation where we're fighting the big banks with one hand tied behind our backs. And I think that what is necessary is to look at proportionality and the proportionality with which regulations can be imposed, and they can be scaled so that they are less onerous for smaller institutions, not to make the regulations on balance less onerous for them, but simply to make the regulations no more onerous than they are for big institutions. And in that regard, I can point you to the South African Conduct of Financial Institutions Bill, Section 7, subsection 1, paragraph A, Section 19, subsection 2, paragraph E, which compels the regulator to scale the imposition of regulations onto smaller financial institutions so that they are not more onerous than those imposed on large institutions. And the last thought I'd like to leave you with in this regard, Senator Pocock, and I'm sure this will appeal to you as an economist, is the Tinbergen rule. In 1952, Jan Tinbergen, the first person awarded the Nobel Prize in economics, said that to successfully achieve independent policy targets, at least the same number of independent policy instruments are required. This came to be known as the Tinbergen rule. And so what we have in the case of APRA is we have one policy instrument one policy tool attempting to drive multiple policy instruments, and they have failed in terms of their remit in respect of competition, and that was the finding of the 2018 Treasury Capability Review.
Mm-hmm. Can I just follow that up, Chair? You're at the same time as pointing us to the Tinbergen rule, you're saying you want to increase the competition mandate for APRA. Is it possible to give the organisation a stronger mandate and expect it to implement it alongside its other objectives?
Well, the 2018 Treasury Capability Review stated that APRA should appoint a competition champion as a member of its executive team. That was 6 years ago, and they've done nothing.
Thank you very much.
Have I got time for one more or not?
Last question.
Okay. Is it fair to say Australian banks make a higher proportion of their profit from mortgages than in comparable countries? And what are the issues with the profit margins of big banks, do you think? And will increases in house prices, what impact will they have on bank profitability? Can you talk a bit about the comparative international story on bank profitability compared to Australia?
Our banking industry is the most profitable banking industry in the world by return on equity. The return on equity that they enjoy is approximately 16%. There's a theory of economics that says in a developing economy, banks should have a return on equity that's broadly similar to that of a utility, 2 to 3%. So while the Australian Bankers Association cries poor and will tell you that their banks are suffering terribly, they are making extraordinary profits by global standards, and those extraordinary profits are being extracted more than anywhere else from mortgages, which has now become I think some 70% of their asset base. So they are primarily mortgage institutions. And if we were to rebalance the competition in the industry so that first-time home buyers could have more opportunities to select mortgages and more competition, if we were to more adequately enliven the free market and to provide first-time home buyers with more choice, those profits would come down and more first-time home buyers would be able to enter the market.
Okay, thank you very much.
Thank you. Thanks, Chair. Important evidence.
Thank you very much. Senator David Pocock.
Thank you, Chair. Thank you very much for your time this morning. Just picking up on that point in response to the question from Senator Barbara Pocock, you're saying that the lack of competition and the extraordinary profit margins of Australian banks is impacting on first home buyers' ability to get into the market?
Yes, because why do those first-time home buyers who struggle to get into the market, why do they struggle to get into the market? Because of affordability. So if you attack problems of affordability, then you make it more likely that they'll be able to raise a mortgage and buy a home.
And when you speak about pushing APRA to enable first home buyers to borrow on better terms, is that in any way similar to the way that first home buyers were given preferential treatment for mortgage applications in Australia in the post-war period when home ownership grew so fast?
Certainly, there's certainly very significant similarities to that. And I'll give you another example. In Hong Kong, the Hong Kong government facilitated first-time home buyers, particularly below a particular income threshold, to borrow a certain amount of money, something in the equivalent of $300,000 at the cash rate. So if you're a first-time home buyer and you want to buy a house and it costs $450,000, you would be able to get the first $300,000 at the cash rate. So that's the rate that the Reserve Bank charges to our banks. And then the remaining $150,000, you've got to find that in the market. And that has been of very significant success in Hong Kong. And I query why we shouldn't explore a similar tool to enable first-time home buyers to enter the market. Give them, call it X. I don't know what that figure should be. I'm not an economist. Call it X. It might be 300,000, might be 400,000. I don't know. X amount of money available to them at the cash rate.
Thank you. That's a really interesting contribution. One of the things I just wanted to ask you finally, I know we're running up on time. The chair often talks about trying to balance the scales between first home buyers and investors. I talk to young people, first home buyers, who are just beside themselves the number of times you turn up to an auction and you get outbid by a property investor. The previous panel was telling me that changes to the capital gains tax discount and potentially negative gearing wouldn't change that at all, even if you allowed the capital gains tax discount to continue for new builds, so you're not constraining supply. Do you have a view on the role that plays in tipping the scales in the favour of property investors who already own property?
Senator Pocock, you have to take that advice from whence it comes. You have to determine whether there is an agenda there. And in my view, that argument is nonsense, and I say this as an owner-investor who's building a property portfolio. The tax regime is to my advantage, and as long as it lasts, I'm going to take advantage of it. And if you remove that advantage from me, I will explore other investments. Will that decrease supply? Yes, it will decrease supply. So how do you mitigate that decrease in supply? By allowing first-time homeowners to enter the market.
Thank you very much. Thank you, Chair.
Thanks very much. Thank you, Dr Schmulow.
Always a pleasure, Senator.